Welcome to Turbo Impact, where we navigate sustainability in private capital. I am your host, Kenny Chen. Each episode, we sit down with investors, allocators, and corporate leaders shaping the next era of sustainability. We explore how capital is driving the global transition and how today's decisions are shaping the future of impact. Thank you for joining us. This podcast is brought to you by Turbo Net Zero, a pure-play sustainability advisory firm driving impact across the private markets. In this episode, I am joined by Suzanne Tavill, Global Head of Responsible Investment at StepStone Group, where she leads responsible investment strategy across one of the largest private market platforms. Suzanne shares her perspective on the next phase of responsible investment in private markets as the industry moves beyond frameworks and the reporting toward a more strategic focus on implementation and sustainable value creation. We explore how this shift is reshaping what good looks like in practice and what investors need to prioritize to drive meaningful outcomes in an increasingly mature and complex market. Here's my conversation with Suzanne Tavill. Hi, Suzanne. Welcome to Turbo Impact Podcast.
Thank you. It's a pleasure to be with you today.
Can you start by telling us about your role at StepStone?
Sure. So I've got the privilege of being the Global Head of Responsible Investment at StepStone Group, which means that I look after everything to do with how we do responsible investment at the firm, be that from pre-investment due diligence to our engagement with our GPs, LPs, and portcos, to how we manage data reporting, disclosure. And then another part of my role is looking after the corporate sustainability obligations that we have as part of the firm. So yes, that is what my role covers. And I suppose I should have said, under sort of the first part of the responsible investment considerations, that embodies all our processes, whether they are around what historically could be regarded as core ESG, but also impact as well.
Thank you, Suzanne. Responsible investment has evolved enormously over the past decade. From your vantage point, working with the private market managers, how would you describe the current state of responsible investment today?
So I think this is a really interesting question, because if we think of any effort or initiative, it goes through a number of phases. And I think responsible investment likewise has moved through a number of phases. And I think, in the early days, it was a space that was dominated by a lot of people who came out of the NGO space, the charity sort of space, really had worked hard at the coalface, on a lot of initiatives, and it was very keen to bring some of that thinking and processes into the financial sort of realm. And I think, this was a period that was dominated by high enthusiasm and a very big build out of process and frameworks, and a lot of sort of deep discussion and debate around those. And ultimately, coalitions, and collaborations being set up. So a really important foundation. I think over time, what we've seen is different people enter the space, and a lot of people who come from a far more financial orientated background. And this, I think, has been actually an important internal driver, as people have looked at that legacy and gone, well, what actually makes sense as we are doing investments, engaging with assets. And obviously all my discussion today is framed with the fact that the work that I do is only within the private market space. StepStone only, of course, invests across the full suite of private markets, from private equity to venture to real estate, private debt, infrastructure, and real assets. So, there is a lot to be done within the context of private markets. And I think the focus has actually been, while a lot can look amazing on paper, it actually takes a huge amount of effort to do implementation in practice. And no one has unlimited time budgets, or unlimited budgets, full stop. And so really trying to understand what to select to do that actually moves the needle for the business, something that the business can get on side with. I think that has been the trajectory, that the space has been moving towards. And I think really this is the phase that we are in, which, nominally, I think has sort of taken on, the labeling around sustainable value creation. So this is very much, I think, I do recognize that obviously some of the political discourse over the last couple of years, which shone a very strong light on fiduciary duty, was an influencer or maybe a catalyst to drive actually what I think was happening anyway in the space.
At the same time, there's growing sense that the industry may be entering a new phase where frameworks reporting alone are no longer enough. Do you think we are reaching something of an inflection point?
So I think, this focus of value creation, I think, is going to dominate versus maybe you could argue a mentality or a overemphasis on process for process sake, which potentially led in some cases, not all, but to a bit of a tick box compliance style mentality. I think a shift away from a compliance style mentality to sort of a practitioner mentality is very much where we're at. The tension when you're making this type of transition is to, is I think across the industry, is to ensure that there's sort of a minimum viable level of standards, right, across the space, to ensure that the practitioner implementation actually is done thoughtfully and to get to some type of real outcome. We can discuss what that type of outcome might be. But I think, yes, I think this is the phase that we're in now.
And one of the challenges in private markets is that many of your GPs, they vary widely in size, resources, and strategies. How would investors think about building responsible investment approaches that are fit for purpose rather than applying one-size-fits-all model?
Yeah, I think this is another important point. And I think, as we've moved away from sort of maybe that more compliance mindset, I think this allows much more flexibility in terms of implementation and an understanding that, the expectations we have for some of the mega buyout players should not be the same expectations that we have for a small buyout, manager. I think at the crux, we have to start from the end goal and work backwards. And I think what becomes important for a GP, whatever its strategy, whatever its size, is to go, where strategically can it make a difference with its portfolio companies? And what can it do that can differentiate that service to potential and existing portfolio companies? So, there is a unlimited list of initiatives and things that could be done to move the dial. But that is not going to suit every GP. Certain GPs are really good with dealing with management and people issues. Other GPs are unbelievable at managing, running playbooks that particularly are around process or sourcing or manufacturing. I think GPs need to lean in to those areas where they have a natural strength and infuse and live that with that sustainability, mindset and activities. But, this ability sort of to be strategic, to pick and choose, that has to be done from a position of knowledge. So it is very difficult for any GP, irrespective of their size, to embark on this path and to be able to authentically argue that they can add value for their portcos if they themselves are not really understanding sort of the subject matter. And so I think at a minimum, people need to have a resource, part of a resource, but with real bandwidth, that can really drive and lead this initiative within a GP. And that person cannot be a junior person. It has to be someone who is of partner or managing director sort of style level, who can take that strategic leadership, figure out what needs to be done, and then hire and resource up appropriately. Because although today I think we were able to do a lot more with a lot less, thanks to improvements of technology, these initiatives do not come, and these efforts do not come without cost. So I think, starting with someone senior to think through and navigate this and figure out what they know versus what they don't know is a critical starting point.
From your perspective, what generally distinguishes high quality, responsible investment integration from approaches that are mostly box ticking?
So I think it really flows from what I've said. I think, GPs that have resourced appropriately within the context of their strategy, and GPs who have gone and developed really thoughtful playbooks that they can run with their portcos and continue to refine those playbooks so they can really evidence, good positive value add from these initiatives is incredibly powerful. It all sounds pretty easy, but having the entire chain of right from the sourcing to the due diligence that gets done to the post-investment engagement, those 100-day plans, seeing sustainability infused through that and spoken about coherently by investment team leads, deal team leads, those I think are really impressive organizations when the discussion at an IC flows seamlessly through topics, for example, that one might traditionally hear, but has integrated discussions around supply chains or concerns about, labor force management. And, that's not a separate RI discussion or done by someone else. That is done and led and understood as deeply by those individuals as sort of margins and return metrics, etc.
Another important dynamic is the relationship between LPs and GPs. As expectations around RI continue to evolve, how do you see the LP-GP dialogue changing?
So I think, LPs have to respond and recognize the change that is happening across the space. And, we started this discussion with me reflecting of sort of a compliance orientated maybe beginnings in the space, or that infused eventually in the space. And, I think LPs have not all, but many have adopted a box ticking style of approach, extensive and potentially untailored questioning to their GPs. And I think, often that's been done by teams that are very disconnected from their investment teams and maybe lack context. And so I think it is really beholden upon the LP community that, as we see our GPs and we are supporting our GPs to drive towards the sustainable value creation orientation. So we as LPs obviously need to make sure that we are tracking as well. And similarly, have that focus and similarly maybe adjust some of our approaches. I think the one thing though is, LPs have to manage that they do require a level of disclosure to be able to report to their stakeholders. And, data is really, really important. Data to evidence that all these efforts that a GP is doing, is driving change. A GP should want to see it, but equally LPs do need to see that as well. And I think that continues to be an area, which is challenging, but I think we will see a fair bit of refinement around that going forward.
RI today is intersecting with a much broader set of issues: technology, geopoliticals, supply chains, and national security. Which of these emerging topics do you think investors should be paying much closer attention to?
So absolutely. I think historically, maybe people thought in these sort of silos of E, S, and G, and somehow things had to fit into either of those. But at its core, what we're trying to do is to create enduring businesses. And for me, technology is front and center, and responsible technology practices. And within that, obviously, AI is front and center. I think, this is a huge area of focus, because this is not about implementing a new ERP system. This is about an approach that is fundamentally changing how we work, how we live, and how our companies that we're investing in are going to be functioning. And if we're not engaged with this topic, then we are passively watching something unfold that is directly relevant to all our stakeholders. And I think the topic of defense, which you rightly flag, this is very closely allied to the topic of technology, because as you know, I feel very strongly that, and we've written about this, defense going forward is heavily infused and heavily, sitting on technology. So again, it's a connected topic in my view.
Impact investing has been gaining traction in private markets as well. How should investors think about the role of impact strategies alongside broader RI approaches?
So, impact obviously has been in a space that has been around since, the 60s. But impact is certainly a space that has created very high barriers to entry. To be regarded as a true impact strategy, you have to line up with, really well-recognized impact frameworks. And, when we look at impact strategies for our clients, we have to make that evaluation. We don't just take the label that a GP might put on themselves as being gospel, because frankly, there are varying levels of practice out there. But one of the challenges is when you create high walls, there's a limited pool of opportunities that actually make that standard, which has meant in turn that the amount of capital going into the space, while it has grown, it still hasn't moved to being at, very, very large scale. And that is a problem because clearly there's a lot wrong with this world, and it would be of huge benefit to see more capital going into the impact space. And the approaches that we see LPs taking now ultimately are one of two. Either they make a defined allocation within an asset class, and they say, within private equity, we will seek to make a X% or dollar allocation to impact. Alternatively, they look across their entire program and they say, we will similarly allocate X% to impact, and there is a total portfolio view to try and navigate through, be it private, public, multiple asset classes, to seek sufficient impact opportunities to meet that allocation. What I would say, though, is some groups who might start by thinking that they want impact are also starting to recognize that, in fact, they don't require such high walls or high barriers. In fact, more what they're wanting is a thematic investment. They want exposure to one of the themes, be it around decarbonization, be it behind, a circularity. But they are not necessarily going to demand of their GPs adherence to those high impact frameworks. And within the thematic investing space, the opportunity set is broader, and certainly a larger amount of capital is able to flow. And I'm not going to say that one approach is better or worse than the other. Obviously, if you want impact, you've got to really make sure you get impact. If you don't mind, then you open up your trajectory. But ultimately, I suppose, if I have any vested interest, it's seeing more capital go into either of these areas, because I do believe at the end of the day, both ultimately are going to drive change. And I think particularly, when I think about areas like venture capital, it is very difficult for venture capital managers to align with some of the impact frameworks, particularly when you're dealing with such emerging businesses. I mean, they don't even have a business plan. How are you asking them to establish intentionality and measure, impact metrics? But potentially something that they develop could be world changing, right? So, that is something that I do think about, and obviously something like that potentially can much more easily sit within a sort of thematic framework.
Thank you for your insights. And looking ahead, where do you think the next chapter of responsible investment will unfold in the next 5 to 10 years?
I think I always think with these things, some things move fast and some things move slowly. And I think the path that we've put ourselves on around sustainable value creation will continue to drive forward, and I think it will be a dominant theme. The wild card, which I think could accelerate things or potentially shift trajectories a bit, is around AI. And I think, we will not be able to disconnect or ignore, the impact of AI in businesses, on the labor market, all of topics that are highly relevant for this space. The exact outcome, I'm not exactly sure. What I am clear about is that today there are some really, really important potential harms or unintended consequences that can come from this technology. And I think, collectively, we all need to be pretty proactive in engaging and having discussions around practices and governance approaches, to ensure that we manage the technology as opposed to the other way around.
Final question to Suzanne. I ask every guest this. What do you think is the most effective way to turbo impact in your field?
I think getting good people involved in the space. In my experience, the moment someone who is engaged and interested in a topic matter, and is empowered within an organization to do something, then change follows. And I think it's incredible what individuals have been able to do across our space. And the change that they've been able to make, in their companies, in their investments. And I actually don't, I don't think that even in a AI-infused world that is going to necessarily change. I think the role of key individuals is critical.
We are very grateful, Suzanne, for your steadfast leadership in driving the change in the industry. And thanks for taking time to join Turbo Impact Podcast.
Oh, it's a pleasure. I appreciate all your effort as well as driving the change.
Thank you.